Picture this. It's 2:14 a.m. A risk manager at a major financial firm refreshes a dashboard for the fifth time in 10 minutes. Nothing is crashing. Markets are technically calm. Stocks are flat. Banks look fine. But one number won't stop blinking. Not losses, not defaults, liquidity. That's the moment the next financial crisis will begin. And it won't look anything like 2008. Back then, the danger was loud. Subprime mortgages, foreclosures, banks collapsing on live television, Lehman Brothers gone in a weekend. This time, there may be no dramatic headline, no iconic villain, no single moment everyone agrees was the start. And that's exactly why it's more dangerous. Because the next crisis won't come from people borrowing too much money. It will come from the system assuming money will always be there when it needs it. And right now, that assumption is doing a lot of heavy lifting. Let's rewind for a second. After 2008, the financial world promised it had learned its lesson. Banks were forced to hold more capital. Risk models were rewritten. Stress tests became annual rituals. And for a while, it worked. The system became safer. Or at least safer in the ways regulators were looking. But finance has a habit of solving yesterday's problems by inventing tomorrow's risks. So while banks got safer, the system quietly shifted elsewhere, out of bank balance sheets, into markets, into funds, into instruments that don't look like debt until they suddenly behave like it. Here's the uncomfortable truth. The modern financial system runs less on solvency and more on liquidity. Not are you rich enough, but can you get cash right now? And liquidity is a confidence game. As long as everyone believes they can sell when they want, prices stay stable. The moment that belief cracks, everything changes. Think of it like a crowded theater. There's nothing wrong with the building. The exits are wide enough. The structure is sound. But if everyone tries to leave at the same time, it doesn't matter how strong the walls are. That's the system we've built. Let's talk about how we got here. Over the last decade, trillions of dollars flowed into passive investing, index funds, ETFs, products designed to be cheap, liquid, and effortless. You click, you buy, you sell. No phone calls, no negotiations, no friction. On the surface, this looks like progress, and in many ways it is. But beneath that convenience is a quiet mismatch. Many of these funds promise daily liquidity. You can exit anytime. But the assets inside them? Not always liquid. Corporate bonds that trade by appointment. Private credit packaged to feel public. Real estate exposure wrapped in ticker symbols. It works beautifully until it doesn't. Because when stress hits, everyone wants out at once. And markets don't fail gracefully. They gap, they freeze, they vanish. This already happened once, in March 2020. Remember that week? Stocks were falling, sure, but the real panic wasn't in equities. It was in U.S. Treasury markets, the most liquid market on Earth. Even treasuries stopped trading smoothly. Bid-ask spreads exploded. Dealers stepped back. The plumbing clogged. The Federal Reserve had to intervene with trillions of dollars, not to save reckless banks, but to keep markets functioning at all. That was the warning shot, and it barely made the history books. Here's the irony. The system didn't break because assets were bad. It broke because they were too widely owned and too easily sold. Speed became the risk. Now layer on leverage, not the obvious margin call on TV leverage of 2008, but quieter leverage, hedge funds borrowing against safe assets, private equity using subscription credit lines, corporations rolling short-term debt over and over, assuming markets will always be open. It's leverage disguised as normal operations, and it works until timing matters. When rates were near zero, none of this felt dangerous. Money was cheap. Refinancing was easy. Time solved most problems. But rates are no longer near zero, and time is no longer free. Higher rates don't just increase borrowing costs, they change behavior, they force decisions, they compress margins, they expose assumptions that were never stress tested. And here's the part nobody likes to say out loud. The models still assume liquidity will appear on demand. They assume buyers will show up. They assume markets will clear. They assume correlations will behave. They assume the future will rhyme with the past. But systems don't fail where they're watched most closely. They fail where confidence is assumed. Now contrast this with 2008. Back then, the problem was solvable in theory. Bad loans could be written down, houses could be repriced, losses could be absorbed. This time, the problem isn't valuation, it's synchronization. Too many participants making the same decision at the same time for rational reasons. No villain, no fraud required, just math. When everyone manages risk the same way, risk doesn't disappear, it concentrates. And modern finance is incredibly good at aligning behavior. Algorithms rebalance together, funds de-risk together, risk models trigger together. The exits get crowded fast. Now zoom out. Governments are more indebted than ever. Central banks are more politically constrained. Demographics are shifting against growth. Geopolitical shocks are more frequent, not less. There's less room for error. In 2008, policymakers could shock the system with stimulus and buy time. Today, inflation limits that playbook. Every intervention has a visible cost. That doesn't mean a crisis is inevitable. It means it will look different. No single collapse, no clean narrative, just a series of temporary facilities, emergency backstops, quiet rule changes over weekends, stability maintained until it isn't. And when confidence breaks, it won't break all at once. It will flicker. A fund gates withdrawals. A market trades by appointment. A spread doesn't close. Small things at first. But finance runs on the belief that small things will stay small. The next crisis won't announce itself with a bang. It will arrive with delays, disclaimers, and footnotes. And by the time everyone agrees it's happening, the real damage will already be done. So here's the question. If the system isn't built to withstand everyone leaving at once, and everyone knows that, what happens the moment people start to believe others might leave first? That's not fear, that's logic. And logic in financial markets is often the most dangerous force of all. So the next time markets look calm, spreads look tight, and everything feels under control, remember this: crises don't repeat, they mutate. And the most important signals aren't the ones screaming for attention. They're the quiet ones blinking in the corner of a screen at 2:14 in the morning. Because once you see the system this way, you start noticing things you can't unsee. And that's when the real watching begins.